Welcome to Ezekiel Academy YouTube channel. In this lecture, I want to examine bankruptcy of partnership. Bankruptcy of partnership. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. In the partnership bankruptcy, the assets and liabilities of the firm are separated from personal assets and liabilities of the partners. So we normally separate the assets and liabilities of the firm from their personal assets and liabilities. The partnership assets and liabilities are dealt with under the joint estate. The assets that belong to the partnership firm, so they will be dealt with under the joint estate. While the personal assets and liabilities of the partners are dealt with under their separate estate. So their personal assets will be separated and it will be dealt with under their separate estates. So I want you to note that the same accounts we normally prepared under the bankruptcy of sole traders or of an individual, same accounts will be required here. So we have the statement of affairs and the deficiency accounts. So I will advise you go back to my earlier videos. Statement of affairs. I have two videos on bankruptcy. So one, I explain the theoretical backup, while the second one, I explain how to prepare the statement of affairs and deficiency account with examples. Statement of affairs is a statement that explains the financial position of the bankrupt as at the given date or as at the date in which the receiving orders are made. So the statement of affairs is similar to statement of financial position with the liabilities at the debit side and assets at the credit side. So I want to note that the major difference between statement of affairs and the statement of financial position prepared for the continuing business is that a breakup basis is used for statement of affairs. We normally use a break-up basis, liquidation basis. That is why we normally use the realizable value of the assets. We normally use their realizable value. But for the statement of financial position, it is prepared on a going concern basis of account. We normally use going concern basis for the statement of financial position. That is why we used to record the assets at their historical cost. But for the statement of affairs, we use a breakup basis. That is why we normally use the realizable value of the assets, not the book value. In statement of affairs, we used to classify liabilities based on their security, whether it is secured or unsecured, or based on their ranking. We used to classify liabilities based on their ranking in statement of affairs. So we used to have whether the liabilities are secured or unsecured or preferentials. But in the statement of financial position, we used to classify liability based on time, on their time frame. How long will it take before those liabilities are settled? That is why we have current liabilities and the non-current liabilities. So that is in the statement of financial position. So go through my first video. I've itemized the differences between the statement of affairs and the statement of financial position. So classification of creditors. All these have been examined in my earlier videos. Classification of creditors. For the purpose of this lecture, I will classify creditors into one, unsecured creditors. Unsecured creditors. Please go through my first two videos on bankruptcy account for better understanding. So unsecured creditors. These are creditors or liabilities that are not pledged on any asset of the entity. Liabilities that are not pledged, they do not have collateral. There are no collateral for this class of creditors. When you look at the question, any liability that has no collateral, you classify them as unsecured creditors. Then, if there are collateral, if they are pledged, those creditors that are pledged on a specific asset of the entity or of the business, we refer to them as secured creditors. Secured creditors. Secured creditors are creditors that are pledged on a specific assets of the business. That means an asset of the business is used as collateral in securing those loans or creditors. In obtaining those creditors, the asset, a particular asset of the business, is used as collateral security. Take note of that. That is secured creditors. These secured creditors, we will categorize it into two. We have fully secured creditors, and partly secured creditors. Partly secured creditors. Remember, I've told you that secured creditors are creditors that are pledged on a particular asset of the business or of the partners. Creditors is fully secured if the value of the liabilities is less than or equal to the value of security. For instance, if a loan of 20,000 naira was obtained and the value of the collateral for that loan amounted to 20,000, that means the creditor is fully secured. If the loan of 20,000 is obtained and the value of the collateral used for the loan is 25,000, the creditor is fully secured. The value of the collateral is greater than the value of the liabilities or equal to the value of the liabilities, or the value of the liability is less than or equal to the value of the collateral security. That is fully secured. But partly secured creditors, a creditor is partly secured if the value of the liability is greater than the value of the security. Is greater than the value of the security. The value of the liability is greater than the collateral for that loan. That liability is said to be partly secured. If the liability is 20,000 and the collateral is 18,000, that means the creditor is secured in part. That is why we call it partly. It is secured in part. That is to show that the liability is not fully secured because the value of the collateral used for the loans or to obtain the loans is lower than the value of the loans obtained. That is partly secured. One thing I want you to note is that when you are comparing the value of the security or the value of the collateral with the amount of the liability, it is the realizable value. Value of the collateral that should be compared with the liability, not the book value. It is the realizable value you need. Then, number 3, I have preferential creditors. A creditor is preferential when they will receive a preferential claims over other class of creditors. They will be settled in priority to other forms of creditors. Their claims will be met before the claims of other class of creditors will be considered. Take note of that. Examples of preferential creditors include all debts due to the state or government. Debts due to the state or government. Those debts that are due to the state or government that are payable within 12 months before the date of the bankruptcy. So if you are owing, if the bankrupt, if they are owing government tax for taxes, the tax that doesn't exceed 12 that doesn't exceed 12 months before the date of the bankruptcy, so we classify them as preferential. That means if the time frame is more than 12 months, you are going to rank them as unsecured creditors. Then we also have wages and salaries, including commission due to employees over a period of 12 months to the date of the bankruptcy, not exceeding 300 naira per employees. Wages or salaries, or including commission, that are due to the employees. Wages or salaries, including commission, that are due to the employees over a period of 4 months to the date of the bankruptcy. And the amount involved must not be more than 300 naira per employee. Where the amount involved is more than 300 naira, let us say you have 3 employees, you have 300 times 3, that is 900 naira. It is the 900 naira of it that will be classified as preferential. Let us assume the wages and salary due to employees is 20,000. If 900 is classified as preferential, out of 20,000, the remaining 19,100 will be ranked as unsecured creditors. Number 3, we have cost incurred in realizing the assets of the debtors. The expenses incurred either by the administrators or by the official receivers in realizing the assets, in selling the assets of the debtors, those expenses, you are going to categorize them as preferential. So you classify them as preferential creditors. Costs incurred by official receiver in protecting the property of the bankrupt. Costs incurred in protecting the property of the bankrupt will be classified as preferential creditors. Then remuneration of special manager. Remuneration of special manager will be categorized as preferential creditors. Please go over my earlier videos on the topic for better understanding. Format of statement of affairs. So we have statement of affairs as at you specify the period. So you have the liability side and the asset side. Assets, then you have liabilities. Let's assume this is B and A. Then joint estate. Joint estate. Estate. Then estimated to realize. Estimated to realize. Then details or particulars. Then if you have B and A, then we have joint estate. Joint estate. Joint estate. Then under the liabilities, we have expected to rank. Expected to rank. If this is A and this is B, A and B, naira, naira. Then let me put naira in two places. For B. For A, naira in two places. For joint estate, naira in two places. This is liability is expected to rank while asset is estimated to realize. So the first liability will be unsecured creditors. Amount expected to rank under the second naira. If A has unsecured creditor, you put it in A column, then same for B. After unsecured creditors, we have fully secured creditors. Fully secured creditors. Then the amount of the liabilities attributable to fully secured creditors, we put that under the first naira. If A have any fully secured creditor, you put it in A column, and AB equally have, you put it in B column. Then you have value of collateral, value of security, or value of collateral. So remember, I told you earlier that a fully secured creditors are creditors whose value of security is greater than the value of the liabilities. That is, the value of liability is less than or equal to the value of security, or the value of security is greater than or equal to the value of liabilities. Then the amount by which value of asset or security is greater than the value of the asset is greater than the value of liabilities, we have that as surplus in hands of fully secured creditors. Surplus that will not be ranked with unsecured creditors. After fully secured creditor, we have partly secured creditors. Partly secured creditors. The value of liabilities with partly secured creditors. If joint estate have, you put it under the first naira. Then if A has or have, you put it under the first naira in column A. Same for B. Then value of security. Value of security. Remember, I've told you for a partly secured creditors, the value of the liabilities is greater than the value of security. Then in this case, you will have a deficiency. Deficiency as regards partly secured creditors. That deficiency will be ranked with unsecured creditors. That is why the amount by which liability is greater than the value of security, you put it under the second naira. So same for B, for A and B. Then after partly secured creditors, then you have the rest of the assets that are not attached to any of the liabilities. That is, the assets that are not used as security. We have cash in hands. If cash in hands is not used as security, put it there. The one by A and the one by B, the one for joint estate. Then cash at bank, if it is not used as security, cash at bank. For joint estate, for A and for B. Then we have stocks or inventories. Inventories or stocks. Inventories not used as security for any of the liabilities. Then you have debtors or receivables. Debtors or receivables. These debtors will be categorized into three. Good. The good will be realized in full. Good debt will be realized in full. Doubtful. Doubtful. The amount realized from doubtful debt is the amount you are going to use, not the total, not the book value of doubtful debts. Then bad. Bad debts, you are not realizing anything from bad debts. That is why I put dash. If land and building is not used as security, land and building, if it is not used as security, so the realizable value is what we are going to include. Then furniture and fittings. Furniture and fittings, if it is not used as security, you have it there. Then others, any other forms of assets, other assets not used as security, you include them. Then you sum them up, the total. You have this as the total. You add the surplus you have here for fully secured creditors. The surplus you have, you add it. Surplus. That is in hands of fully secured creditors. You add that surplus. So you have this as the total. You now deduct preferential creditors. Preferential creditors. You deduct preferential creditors, if any. Then assume you have preferential creditors for joint estate. If A have and B. After deducting preferential creditors, you have this as the balance. Then you add your liabilities. If the liabilities is greater than the asset, the realizable value of the asset, you have deficiency. Deficiency. The deficiency here will be the balancing figure. Balancing figure. The amount by which the total of the liabilities is greater than the total of the asset, that is the deficiency. So you add it. Then you have the total. So, but if the credit side is greater than the debit side, you have the surplus. Surplus, the surplus here will be the balancing figure. Balancing figure. You either have surplus or deficiency, not both. No, I'm giving you both in the format. It is possible the joint estate may be having deficiency, while B will be having a surplus. That means if B is having a surplus, then B will not have a deficiency here. B will not have deficiency here. If A is having surplus, A will not have deficiency here. So it is either surplus or deficiency. So let us assume joint estate is having a surplus. You add the surplus. If A is having a surplus, you add it. And if B is having a surplus, you add it. Then the total. So let me divide this column. This is the format for preparing the statement of affairs. Let's examine the deficiency accounts. Deficiency accounts is the account that shows how the deficiency have arisen. Deficiency accounts. This is the account that shows how the deficiency have arisen. It is the opposite of the statement of profit or loss. Knowing the statement of profit or loss, you used to have income at the credit side, while expenses at the debit side. So the opposite of it is the deficiency account. That means you'll be having gains. Gains at the debit side. You have the gains. And at the credit side, you have the loss. So please take note of this. So at the debit side, as I've said, you have items reducing deficiency. No, gains will result in reduction in deficiency. So you debit items reducing the deficiency. And loss will contribute to the deficiency. That means at the credit side, you have items contributing to deficiency. So now let me give you the format for the deficiency account. So you have deficiency or surplus accounts. So you have B, A, you have joint estate. Details. B, A, joint estate. You start with capital. Capital or excess of assets over liabilities. The capital for A and B may not be given, so you will need to calculate that. I will give you the format for calculating this. Let me just put working one there. So, but where liabilities is greater than the asset, so you have it here. Excess of liabilities over assets. Where liability exceed assets. Let's assume liability of A and B is greater than their assets. So you have the excess there. Then potential gains. Potential gains on. So I've told you have gains at the debit side. Gains on, let's assume you have higher purchase assets. Higher purchase asset. It will result in a gain where the carrying amount or book value is lower than the realizable value. You have the gains where the book value is lower than the realizable value. That is, the realizable value is greater than the book value. Inventories of stocks. Inventories where the realizable value is greater than the book value, you have the gains. So you have for the joint estate, then you have for the individual partners, which will be calculated same way. So where the realizable value of land and building is greater than the book value, then you have gains. So you may have for the individual estate. Then for receivables or debtors, where the realizable value is greater than the book value, then you have the gains. Then for furniture and fittings, where the realizable value is greater than the book value, you have the gains. Then for life assurance policy, where the realizable value is greater than the book value or the cost of the asset, then you have the gains. Let's assume A and B have life assurance policy. Then you have the deficiency as per statement of affairs. The statement of affairs you have calculated or you have prepared. Deficiency as per statement of affairs. So I've told you either have the deficiency there or you have the surplus. So, but potential loss on where you have loss on the asset. You have loss where the book value is greater than the realizable value of the asset. We have higher purchase assets. It may result in loss. A loss if the realizable value is lower this time around. But a profit or gains where the realizable value is greater than the book value. Then we have inventories of stocks. So you may have the loss where the realizable value is lower. For land and building, where the realizable value is lower, you have the loss. The difference between the book value and the realizable value. That is what we'll be recording as either gains or loss. Then receivables or debtors, where the realizable value is lower, so you may have loss. Furniture, if the realizable value is lower, furniture. Then life assurance policy. Life assurance policy. If the realizable value is lower, then as you have for A and B. Plus, as per statement of affairs. Remember, I've told you you either have surplus or deficiency, not both. So you might end up having surplus or deficiency, not both. Then the deficiency account will balance itself. Then calculation of working number one, calculation of capital, calculation of capital. Remember, capital is excess of assets over liabilities, or excess of liabilities, over assets. So to calculate this, you start with the assets. It is at cost. You calculate for individual partners. Let us say you have B and A as well. You want to calculate their capital or excess of assets over liabilities. So the assets might include land and building. You might have life policy, life assurance policy at cost. You include them at cost. Then furnitures and fittings. Then various other assets. Others. You get the total assets. You now less liabilities. Liabilities might include creditors, accruers, bank overdraft, and other liabilities. So if you subtract all the liabilities, you get capital. If it is positive, it is capital. But if it is negative, it is excess of liabilities over assets. So you either have capital, or excess of liabilities over assets. Excess of liabilities over assets. It is from this working one that you will get what you have as capital here, or what I have as excess of liabilities over assets. So that is how we got that. So this is the format for preparing deficiency account. Now let's take question as work example. Keep watching. Example. On 31st December 2008, a receiving order in bankruptcy was made against Osman and Saddam, trading in partnership. The balance sheet of the partnership on that date was, we have capital and liabilities, then we have assets. Capital, Osama 1,500, Saddam 2,500. Building society, secured on building 5,000. Hire purchase creditors 1,400. Building 7,500. Hire purchase plant 800. Debtors 23,640. Other plant 3,500. Creditors 26,980. Bank overdraft 12,000. Total 49,380. Then we have stocks 13,790. Cash 150. Total 49,380. Additional information. 1. The assets were estimated to realize the following amounts. Buildings 2,000. Stock 5,630. Hire purchase plant 600. Other plans 1,320. Note 2. The debtors are analyzed as stated below. Good 12,790. Doubtful 3,600. Estimated to realize 2,000. Bad 7,260. Note 3. Personal assets and liabilities of partners. You have estimated worth of assets, cost in brackets. We have Osama, we have Saddam. Furniture 1,000, the cost is 1,400. For Saddam, 1,600, the cost is 1,900. Investment 2,000, 1,600 being the cost. For Saddam, 2,400, 2,640 being the cost. Bank, knee, at 6,200. Building, knee, 6,000, the cost is 6,360. Life insurance policy, 3,800, the cost is 2,900. And for Saddam is knee. Liabilities, we have bank overdraft. For Osama, 800. Saddam, knee. Creditors, Osama, 5,200. Saddam, 1,700. Mortgage on building, we have for Osama, knee. For Saddam, 2,200. You are required to prepare as at December 31st, 2008 as regards the joint estate and separate estates of the partners in column form. A. Statement of affairs. B. Deficiency account. This question is obtained from American study test by DI Publisher. We have Osama and Saddam. Osama and Saddam. So the first requirement, you have to prepare statement of affairs, statement of affairs as at December 31st, 2008. So at the credit side, they have Saddam. Let also have Osama. They have joint estate. Joint estate. So Osama, Saddam, Saddam, Osama, then we have joint estate. This is the liability side, amount expected to rank, and at the asset side, we have estimated to realize amount in Naira. So now, working one, let's do the analysis of the liabilities of the partnership. Analysis of partnership liabilities. We have a column for total liabilities. Now, the liabilities of the partners include building society secured on building. By building society, it means it's a building society loan. Building was used as a collateral for such a loan. That amounted to 5,000. So now let's have building society loan, building society loan. And that amounted to 5,000 naira. Then we have hire purchase creditors, 1,400. Hire purchase creditors, that amounted to 1,400. Then we have creditors, 26,980. Creditors, 26,980. We equally have bank overdraft, 12,000. Bank overdraft, 12,000. These are the liabilities of the partnership business. Remember, building society loans was secured on building. So you have to compare the amount of the loan with the collateral used for such a loan. No building was used as a collateral. It is not the book value you need. It is the realizable value of the collateral, not the book value. Please take note of that. Now, how much is the realizable value of the building? No, this is the book value. We need the realizable value of the building. The realizable value of the building is 2,000, and it was secured on a building society loans of 5,000. The value of the liability is greater than the value of the collateral. Therefore, it is partly secured. It's not fully secured. It is partly secured creditors. So, since the value of the loans is greater than the value of the collateral, so it is partly secured. So that amounted to 5,000 naira. The next liability is hire purchase creditors, amounted to 1,400. Remember, it is the value of the asset that will be used as collateral for hire purchase creditors, because the dealer can still repossess the asset if the buyer fails to, or if the buyer defaulted in paying any of the installment as at when due. The asset can be repossessed. So the value of the asset, the realizable value of the hire purchase asset, will be the collateral for it. So how much is the realizable value of the hire purchase asset? So hire purchase plant, 600. The realizable value is lower than the value of the liability. So it is equally partly secured creditors. It is partly secured. So creditors, we have 26,980. No collateral was used for the creditors anywhere. Since no collateral is used for this, so we categorize this as unsecured creditors, because it does not have any collateral. So no collateral is used for it. So we have 26,980. That is unsecured creditors. The bank overdraft. Bank overdraft does not have any collateral as well, since there is no collateral for the partnership bank overdraft, not the individual bank overdraft. There is no collateral for partnership bank overdraft. As a result of that, the bank overdraft will equally be ranked as unsecured creditors. So 12,000. So let's total it. This is totaled 6,400. 6,400. That is the total of the partly secured creditors. So now let's total the unsecured creditors. 26,980 plus 12,000. And that is total 38,980. 38,980. Now, let's record that. So the first liability that will be recorded is unsecured creditors. Unsecured creditors. That amounted to 38,980. 38,980. After unsecured creditors, we have fully secured creditors. We did not have fully secured creditors for joint estate. After fully secured creditors, we have partly secured creditors. The partly secured creditors is totaled 6,400. 6,400. How much is the value of the security? Value of security. Remember, for building society loan, building was used as security for that. I've told you the value you need is not the book value, but the realizable value. The realizable value of building is 2,000. So we write that 2,000. Then after building, the second one is hire purchase creditors. Since this asset can be repossessed, as I've said earlier, it can be repossessed if the buyer defaulted in paying any of the installment, that the value of the asset should be the collateral for the asset. So hire purchase plant, the realizable value is 600. Hire purchase plant, that amounted to 600. If you total this, you have 2,600. That is the value of the collateral for partly secured creditors. So we have 2,600. If you subtract 2,600 from 6,400, 6,400 minus 2,600, so you have 3,800. 3,800. The remaining balance will be ranked as unsecured creditors. That is why I'm putting that under the second naira. The rest of the assets not used as security, we are going to credit them. So number one, we have cash. No, you cannot sell cash to receive cash. So that is why I'm taking that cash, 150. Then we have buildings have been used as collateral. I've told you it is the realizable value of the asset that should be used, not the book value. The only thing I feed from the statement of financial position is the cash. So the rest of the asset that will be used in the statement of affairs to be the realizable value. Building have been used as collateral, so you don't need that. Stock, 5,630. Stock, 5,630. So that is for the joint estate. Then hire purchase plant have been used as collateral. We have other plant, 1,320. Other plant, 1,320. 1,320. Note 2. The debtors are analyzed as stated below. So debtors, we have good debts, 12,780. 12,780. Then doubtful debts. The book value is 3,600, but it is estimated to realize 2,000. It is the realizable value we need. 2,000. That is the realizable value of doubtful debts. Then we have bad debts. Bad, 7,260. Since it does not have any recoverable value, so we put dash. Let's check out the personal liabilities of the partners. We have bank overdraft. We were not told it is secured on any of the assets. So that is to show that bank overdraft is unsecured. Unsecured. Then creditors, we were not told it is secured. So that is to show that the creditor is unsecured as well. But mortgage on building, that is to show that building was used as collateral. So how much is the realizable value of the building? I've told you what you need is the realizable value, not the book value. So you were told the estimated worth of assets, cost is in bracket. So those one in bracket, they are the cost of the asset. That's to show that the realizable value of the building is 6,000. You compare it with the amount of the liabilities, 2,200. So the realizable value is greater than the amount of the liabilities. That is to show that mortgage on building is a fully secure creditor. So how much is the mortgage loan? 2,200. So fully secured creditors, 2,200. How much is the value of the collateral? The value of the collateral, which is building, that is 6,000. So we have 6,000. 6,000. If you subtract 6,000 minus 2,200, you'll be left with 3,800. That 3,800 is the surplus in hands of fully secured. Surplus. The surplus is 3,800. So remember, we said the bank overdraft, we said it is unsecured. So Osama, unsecured creditors for Osama, working 2. Unsecured creditors. That is for Osama. It comprises bank overdraft 800, bank overdraft 800 naira. Then we also have creditors 5,200. Creditors 5,200. That is totaled 6,000. The unsecured creditors for Osama amounted to 6,000. Unsecured creditor, that would be the first item. Then for Saddam, unsecured creditors, we have creditors 1,700. That means the unsecured creditors for Saddam is 1,700. Unsecured creditors 1,700. Other assets not used as collateral include furniture. So we have furniture. Joint does not have furniture. Then Osama 1,000. Saddam 1,600. Osama 1,000. Saddam 1,600. We have investment. 2,000 for Osama, 2,400 for Saddam. Investment. Investment Osama 2,000. For Saddam 2,400. We have bank 6,200 for Saddam. Cash at bank, blank, 6,200 for Saddam. We have life insurance policy. Life policy. The life policy, the LSA value is 3,800 for Osama. 3,800. Then, if you look at the statement of affairs, the liability section here, we have a surplus in the asset because the value of the asset is greater than the value of liability for fully secured creditors. So now let's have surplus in hands of fully secured creditors. Surplus, that is for Saddam, 3,800 surplus. 3,800 as the surplus. Now let's add. For the joint estate, the liability is total 42,780. The asset side, we say is total 21,880. If you subtract it, now 21,880, we have difference of 20,900. That is the deficiency as per statement of affairs. Deficiency. Deficiency. As per the statement of affairs, and that is 20,900. The total is 42,780. For the individual partner, so the debit side of Osama is total 6,000. Now let's add the credit side. 1,000 plus 2,000, that is 3,000 plus 3,800, that will be 6,800. The credit side is greater. 6,800. That is for Osama. 6,800. So since this is 6,000, you have difference of 600. That will be surplus. That will be surplus of 800. 6,800 minus 6,000, that will be 800. So you have surplus of 800. Then for Saddam, you don't need to add the surplus. This is surplus. And that surplus will be transferred to the credit side here. You don't need to add it to 1,700. The liability is 1,700. Then let's add the liability side. So with the look of things, the liability, let's add the asset side. 1,600 plus 2,400 plus 6,200 plus 3,800. The asset is totaled 14,000. 14,000. If you subtract 1,700, we have at the debit side from that, from the 14,000 minus 1,700, you have 12,300. That is the surplus, 12,300. That is the statement of affairs. The next requirement is to prepare the deficiency accounts. In the B part of the question, you want to prepare the deficiency account. They have deficiency or surplus account. Deficiency or surplus account. We have joint estate. Then we have Osama. Osama. Then we also have Saddam. Joint estate. Osama, Saddam. At the left hand side, we have items reducing deficiency. And at the right hand side, we have items contributing to deficiency. Among the items that will reduce the deficiency is their capital. We have capital, Osama 15, Saddam 2,500. So capital 15 plus 25. That is total 4,000. 4,000. Then let's check the asset one after the other. Building, the book value is 7,500 and the realizable value is 2,000. This will lead to a loss because the realizable value is lower. That means we have loss, potential loss from building. Potential loss from, we have building, 7,500 minus 2,000. Then we have 5,500. 5,500. That is 75 minus 2,000. That gives us 5,500. We have higher purchase plant. The book value is 800. The realizable value is 600. So we have the loss on higher purchase plant. Higher purchase plant, book value of 800 minus 600. So you have a loss of 200. 800 minus 600. That's how I got the 200. Then we have other plants, 3,500. Other plants, 3,500. The realizable value of other plants is 1,300. 1,320. Other plants. So let's subtract that. 3,500 minus 1,320. We have 2,180. Then we have stocks, 13,790. And the realizable value is 5,630. 13,790 minus 5,630. You can be displaying the workings in your book so that you'll be able to understand it better. I don't want my work to be too rough. That is why we only do the workings with my calculator. So we have stocks, 8,160. Then we have debtors, 23,640. Debtors, the bad debts. This one is good. That means it is fully recovered. But this one, 3,600, only 2,000 can be recovered. 1,600 will be bad. So the 1,600 plus 7,260, that will give you the bad debts. 3,600 minus 2,000 plus 7,260. 3,600 minus 2,000, that is 1,600 plus 7,260. So we have 8,860. 8,860. Note 3. Personal assets and liabilities of partners. Estimated worth of assets and cost in bracket. We have furniture. The cost is 1,400 and it is estimated to realize 1,000. That means it has a potential loss of 400. So for Osama. So furniture, so 1,400 minus 1,000, that will be 400. Furniture for Saddam, 1,900 minus 1,600, loss of 300. Loss of 300. Then we have investments. The realizable value is greater than the book value. That's for Osama. That's to show that Osama investment will give rise to a profit of 400. So we have profit from sale of investment. Sale of investment. Remember, I've told you items reducing deficiency. I said those items will be debited. So the profit will lead to reduction in deficiency. That is why we are debiting that. So how much is the profit? 2,000 minus 1,600, 400. That is for Osama. 400. Profit of 400 is the difference between 1,600 and 2,000. But that of Saddam will lead to a loss because the cost is greater than the realizable value. Loss from sale of investment, 2,640 minus 2,400. That will give us 240. Loss of 240. Bank, you don't need to consider that because it will be recovered in full. No loss, no gain. Building for Saddam, the book value is greater than the cost. That will lead to a loss. So we have building for Saddam, 6,360 minus 6,000. That will be 360. Building for Saddam, 360. We have life insurance policy for Osama. The realizable value is 3,800, while the book value is 2,900. 3,800 minus 2,900, that gives us 900. So it is a profit. So we have life assurance policy or life policy, profit of 900. That is the difference between 3,800 and 2,900. From our statement of affairs, we had a surplus. Surplus of 800 under the Osama. Then for Saddam, we had 12,300. 12,300. In the joint estate, we have deficiency. Deficiency of 20,900. Deficiency, as per statement of affairs, 20,900. Working 3. Calculation of personal capital. Personal capital of the partners. It is the cost that will be used. Remember, you have been told costs are in brackets. The figure in brackets is what you need in respect of each of the assets. We have Saddam, then we have Osama. Their assets include furniture. So it is not the realizable value that will be used. You use the book value, which is 1,400 and 1,900. Then we have investment. Investment, 1,600 is the book value or the cost, and 2,640. Then we have bank. Bank. Osama has D, while the other person has 6,200. Building. Building. Osama is Ni. That of Saddam, 6,360 is the book value, the cost. Life insurance policy. Life insurance policy. Life insurance policy cost is 2,900 and Ni. So let's sum up the assets. 1,400 plus 1,600 plus 2,900. That is total 5,900. Then for Saddam, 1,900 plus 2,640 plus 6,200 plus 6,360. That is total 17,100. Then you now deduct the liability. The liabilities include bank overdraft. Bank overdraft. That amounted to 800 for Osama, Saddam, Ni. Creditors, 5,200 for Osama, for Saddam, 1,700. Then mortgage building. Mortgage building. That is Ni and 2,200. Here we have capital. 17,100 minus 1,700 minus 2,200. So we have 13,200. 13,200. Then for Osama, 5,900 minus 800 minus 5,200. You have 100. Capital. This one is negative, minus 100. That means you have excess of liabilities over assets here. But here the asset is greater than liabilities, so we have capital. So capital is 13,200 for Saddam. Capital for Saddam 13,200. But for Osama, we have excess of liabilities. Excess of liabilities over assets. Because liabilities is greater than asset by 100. That is for Osama. Osama. We have 100. For joint estate, 4,000 plus 20,900. That will be 24,900. 24,900. Then the credit side, joint estate. We have 5,500 plus 200 plus 2,180 plus 8,160 plus 8,860. The credit side is total 24,900. 24,900. So this one balance now. Then for Osama, 400 plus 900, that will be 1,300. Let's add the credit side of Osama. 400 plus 800, that is 1,200 plus 100, that will be 1,300. 1,300. Osama also balance. For Saddam, we have 13,200. 13,200. Let's add the credit side of Saddam. 300 plus 240, that is 540 plus 360 plus 12,300 is totaled 13,200. 13,200. So our deficiency account balance. So you see 13,200. So they both agree. This marked the end of the solution to the question. Please drop the love emoji, like the video, also share it with others. Thanks for watching Ezekan.